Imagine for a moment that you are a detective. You arrive at the scene of a potential partnership, a business that could secure your financial future. The person in charge, the chief executive officer, greets you with a wide smile and a firm handshake. He speaks of vision, of synergy, of a hockey stick growth trajectory that will create unprecedented shareholder value. His words are polished, his presentation is flawless, and his confidence is infectious. You are tempted, powerfully tempted, to believe him, to trust him, to hand over your hard-earned capital based on the power of his story. But a great detective knows that the most compelling stories can also be the most dangerous lies. A great detective knows that the truth is rarely found in the polished presentation. It is found in the evidence. For the greatest financial detective of our time, Warren Buffett, that evidence is not hidden in secret memos or insider tips. It is laid bare for all to see, published quarterly and annually for the entire world. It is the company's financial statements. And to Buffett, these documents, the income statement, the balance sheet, the cash flow statement, and their footnotes, are not just a collection of numbers. They are a confession. They are a psychological profile. They are the single most reliable test of a CEO's character, integrity, and competence. Buffett has built a multi-hundred-billion-dollar empire on a simple, profound, and almost universally ignored principle. The quality of a company's accounting is a direct reflection of the quality of its management. This isn't an abstract idea. It is the ultimate tool for risk management. It is the firewall that has protected him from the great corporate blow-ups of the last 70 years. From Enron to WorldCom, from Valiant to WeWork. While other investors were mesmerized by charismatic leaders and exciting narratives, Buffett was quietly in the corner, reading the financial reports. And in those pages, he was not just looking for profits. He was looking for honesty. He was looking for clarity. He was looking for a CEO who wasn't trying to sell him a story, but was trying to explain a business. The costly mistake this principle prevents is perhaps the most common and catastrophic error in all of investing: partnering with the wrong people. Investing in a company that uses aggressive, confusing, or deceptive accounting is like building a house on a foundation of sand. The facade may look beautiful for a time, but a storm will eventually come, and the entire structure will collapse, taking your capital with it. The financial transformation that awaits you on the other side of this understanding is a form of investment enlightenment. You will learn to prize companies with simple, clean, and conservative financial statements. You will see them not as boring but as beautiful. You will view a clear, plainly written annual report as a sign of an honest management team you can trust with your money. You will shift your due diligence from a hunt for growth to a hunt for truth, and in doing so, you will build a portfolio not on fleeting stories, but on the bedrock of character. This is the final promise of accounting, that behind the numbers lies the truth, not just about a business, but about the people entrusted to lead it. Our journey into this critical Warren Buffett strategy begins with the most fundamental pillar of his philosophy, a concept so simple it is often dismissed as trivial, yet so powerful it forms the foundation of his entire approach to corporate governance. This is the gospel of simplicity and clarity. Buffett believes, with an almost religious conviction, that great management teams have a deep, burning desire to be understood. They are not insecure. They are not trying to prove how smart they are with complex jargon or convoluted financial structures. They run good businesses, they know they run good businesses, and they want you, the owner, to understand exactly how that business works and how it makes money. A CEO who deliberately obscures reality through complexity is, in Buffett's view, not a partner but an adversary. To truly grasp the power of this idea, we must travel back to 1972. The stock market was in the grip of the Nifty 50 era, a time when a group of 50 large-cap stocks like Xerox, IBM, and Polaroid were considered so dominant, so invincible, that you could buy them at any price and hold them forever. Financial engineering was becoming fashionable. Conglomerate, sprawling empires of unrelated businesses cobbled together through acquisitions were the darlings of Wall Street. Their annual reports were often hundreds of pages of dense, impenetrable text, celebrating the genius of the executives who could manage such complex beasts. It was a time when complexity was equated with sophistication. Into this environment walked Warren Buffett and Charlie Munger, armed with the capital of Berkshire Hathaway and a deep-seated skepticism for anything they couldn't understand. They were presented with an opportunity to buy a company called See's Candies. On the surface, it was the antithesis of the Nifty 50. It was a simple, family-owned box chocolate company based in California. There was no disruptive technology, no complex algorithm, no global network effect. They made chocolates and sold them in stores. The CEO, a man named Charles Huggins, presented Buffett and Munger with the company's financial history. There was no fancy PowerPoint presentation, no talk of leveraging synergies or optimizing platforms. There was just a set of clean, simple, and utterly transparent financial statements. The numbers showed a business with remarkable pricing power. Year after year, See's had been able to raise its prices slightly, and its devoted customers didn't flinch. This small price increase, applied across millions of pounds of candy, resulted in steadily growing profits that required almost no additional capital investment. The beauty of See's wasn't in its complexity, but in its simplicity. The business model was so clear that Buffett and Munger could understand its economics in a matter of minutes. The accounting was conservative and straightforward. There were no aggressive revenue recognition policies, no off-balance sheet entities, no confusing footnotes designed to obscure reality. Charles Huggins wasn't trying to sell them on a story. He was presenting the facts of the business with unadorned honesty. He spoke like a proprietor, an owner, not a promoter. He laid out the good and the bad, the opportunities and the challenges. The financial statements were a perfect reflection of his management style, direct, honest, and focused on the long-term fundamentals. Berkshire Hathaway bought See's Candies for $25 million. It was a price that seemed high at the time, more than 3 times its book value. But Buffett understood that he wasn't just buying recipes in retail stores. He was buying a jewel of a business run by a management team whose integrity was reflected in the crystal clarity of their accounting. Since that purchase, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, capital that required almost no reinvestment and could be used to buy other great businesses. It became a foundational lesson for Buffett. The simplicity and honesty in the financial reporting of Charles Huggins was not an incidental detail. It was the signal. It was the green light that indicated a trustworthy partner and a durable business. The profound effectiveness of this focus on simplicity is rooted in a powerful psychological principle known as the fluency heuristic. Our brains are wired for cognitive ease. We have a subconscious preference for things that are easy to think about and process. When we encounter information that is clear, simple, and fluent, we are more likely to judge it as true, trustworthy, and valuable. Conversely, when we are presented with something that is complex, convoluted, and difficult to process, what psychologists call disfluent, our mental alarm bells start to ring. We become more skeptical, more cautious, and we are more likely to believe that the complexity is masking a flaw or a deception. Most people think of this as a cognitive bug, but Buffett has weaponized it as a feature of his due diligence process. When a CEO writes an annual report filled with jargon, buzzwords, and sentences that twist and turn like a labyrinth, they are creating a disfluent experience for the reader. They are making it hard for you to understand. The average investor, often suffering from a form of intellectual insecurity, might react by thinking, "Wow, this is really complicated. These guys must be incredibly smart. This business must have a deep technological moat that I'm just not clever enough to grasp. This is a catastrophic error." Buffett's reaction is the exact opposite. He thinks, quote, "This is really complicated. This CEO is either a terrible communicator or he is deliberately trying to hide something. In either case, I don't want to be his partner." He understands that fluency is a proxy for honesty. A manager who truly understands their business can explain it in simple terms. A manager who wants you, the owner, to be a true partner will make every effort to ensure you understand it. The CEO who uses complexity as a smokescreen is treating shareholders not as partners, but as marks, useful idiots who provide the capital but are too dumb to be let in on the real secrets. The fluency heuristic explains why the C's Candies report was so appealing. Its clarity and simplicity created a feeling of trust and confidence. It was easy to process, which made its underlying quality feel more real and dependable. The complex reports of the 1970s conglomerates, by contrast, should have triggered skepticism, a feeling that something was being hidden in the fog of words. Buffett's genius lies in his discipline to listen to that subconscious alarm bell and treat complexity not as a sign of sophistication, but as a giant red flag. So how can we translate this powerful principle into a practical, repeatable process? We can use a mental model that I call the fifth grader test. It's a simple blueprint for applying Buffett's lens of clarity to any potential investment. The next time you are analyzing a company, do not start with the stock chart or the analyst ratings. Start with the source document, the company's latest annual report, the 10K filing. You can find this for free on any public company's investor relations website or in the SEC's EDGAR database. Step 1. Open the document and navigate to the section called Item 7, Management's Discussion and Analysis of Financial Condition and Results of Operations, or simply the MD&A. This is the part of the report where the management team is supposed to explain, in their own words, what happened in the business over the last year. Step 2. Read the first 3 or 4 paragraphs of this section. This is where the CEO and CFO set the tone for the entire document. Don't skim. Read it slowly, word for word. Step 3. Put the document down and ask yourself a simple, honest question. Could I now walk into a classroom and explain the core business model of this company and its basic performance over the last year to a group of intelligent fifth graders? This question is crucial. It's not about dumbing it down, it's about distilling the essence. An intelligent fifth grader doesn't know what, quote, amortization of intangible assets means, but they can understand, we sell software and we signed up more customers this year, but we had to spend a lot more on advertising to do it. Step 4. Analyze your answer. If your answer is a confident yes, that is a massive green flag. It means management is communicating with clarity and directness. They are likely proud of their business and want you to understand it. If your answer is no, you must dig deeper. Why not? Was it because the language was filled with industry jargon that was never explained? Did they use vague, meaningless corporate speak like leveraging our core competencies to optimize our strategic initiatives? Did they bury the lead, talking for pages about minor achievements before mentioning a major loss? Step 5. If you cannot pass the fifth grader test, you must treat it as a significant mark against the company's management. It doesn't automatically mean there is fraud, but it does mean there is a lack of clarity, and a lack of clarity increases your risk exponentially. A business you cannot explain is a business you cannot properly value. If the CEO cannot or will not explain it to you in simple terms, you have no business being their partner. This mental model forces you to weaponize the fluency heuristic, just like Buffett does. It transforms you from a passive recipient of information into an active detective, judging not just the content of the words, but the character revealed by their clarity. To fully appreciate the wisdom of this path, we must examine its opposite. We must walk the path of the 99%, the one paved with complexity and ruin. This is the path of the sophistication trap. Most retail investors and even a shocking number of financial professionals are deeply insecure about their own intelligence. When confronted with a company like Enron in the late 1990s, they saw its impenetrable financial statements not as a warning, but as a challenge. Enron's annual reports were monuments to obfuscation. They talked about special purpose entities, merchant investments, and a business model that was so complex even seasoned energy analysts couldn't fully explain it. The common investor caught in the sophistication trap thought, I don't get this, but Wall Street loves it, and Fortune magazine called them the most innovative company 6 years in a row. The problem must be me, I'm just not smart enough to see the genius. This is a fatal cognitive error. They mistook deliberate complexity for a sign of a deep intellectual moat. They believed that because they couldn't understand the accounting, the business must be operating on a higher plane of genius. They were intimidated into silence and, ultimately, into writing a check. The reality, as we now know, was that the complexity was not there to describe a brilliant business model. It was there to hide the fact that there was no sustainable business model at all. It was a camouflage for fraud. The sophistication trap is baited with our own insecurity. The 99% fall for it because they believe that smart people use big words and complex sentences. They chase after the hot tech company with a business model explained in buzzwords, or the complex financial firm using derivatives they can't define. They ignore the simple, boring, but crystal clear annual report of a company like See's Candies because it feels too simple, too unsophisticated. They equate easy to understand with low growth or old-fashioned. Buffett does the opposite. He equates easy to understand with honest and predictable. The path of the 99% leads to a portfolio filled with black box companies, businesses where you put money in and hope that something good comes out without ever truly understanding the mechanism inside. This is not investing. It is speculation of the most dangerous kind, because you are not only betting on the business, you are betting that the complexity you don't understand isn't hiding a catastrophic failure. The direct financial connection between clarity and wealth creation is concrete and powerful. It all comes down to the ability to forecast and value a business. The goal of any serious stock analysis is to determine a company's intrinsic value, a conservative estimate of what the business is truly worth. This is typically done by projecting its future cash flows and discounting them back to the present. The quality and clarity of the financial statements directly impact the reliability of this process. When a company like See's Candies has a simple business model and presents its numbers with honesty and clarity, an investor can make a reasonably confident forecast. You can look at the history of price increases, the stable customer base, the minimal capital requirements, and project future owner earnings with a relatively narrow band of uncertainty. This confidence allows you to calculate a more reliable intrinsic value. This, in turn, allows you to apply Buffett's famous margin of safety. You can buy the stock only when it trades at a significant discount to your calculated value, protecting your portfolio from forecasting errors or market downturns. Now, consider the opposite: a company with a complex business model and an opaque annual report. How can you possibly forecast its future cash flows with any degree of confidence? If the management uses jargon and convoluted sentences to describe last year's performance, how can you predict the next 10 years? The answer is, you can't. The range of possible outcomes is enormous. Any valuation you attempt is not an estimate. It's a wild guess. This massive uncertainty obliterates any chance of establishing a meaningful margin of safety. Investing in such a company forces you to rely on hope. Hope that the smart-sounding CEO knows what he's doing. This is a terrible foundation for wealth management. Clarity in accounting reduces risk. It narrows the cone of uncertainty around a company's future, allowing for more rational valuation and better capital allocation decisions. Complexity does the opposite. It introduces a fog of uncertainty that makes intelligent valuation impossible and turns investing into a gamble. By choosing partners who speak in plain language, Buffett isn't just seeking comfort. He is engaging in a sophisticated form of risk management that has been central to his success and portfolio protection for over half a century. Moving beyond the foundational need for clarity, we arrive at the second, more technical pillar of Buffett's analytical framework. This is his profound skepticism of standard, reported earnings, and his unwavering focus on the true economic reality of a business. He articulated this through his own invention, the concept of owner earnings. This pillar is built on a crucial insight. Generally Accepted Accounting Principles, or GAAP, the official rule book for corporate accounting, are not a set of immutable laws of nature. They are a set of conventions created by committees that allow for a wide range of interpretation and, therefore, manipulation. A clever CEO can follow all the rules of GAAP and still present a deeply misleading picture of their company's profitability. Buffett, therefore, insists on looking past the headline number and calculating the real cash profit a business generates. The genesis of this idea can be found in his legendary 1986 letter to Berkshire Hathaway shareholders. The context of the mid-1980s is critical. It was the era of the corporate raider, the leveraged buyout, and the junk bond king. Financial engineering was rampant, and Wall Street was obsessed with reported GAAP earnings per share. CEOs were under immense pressure to show smooth, ever-increasing profits, and they used every accounting trick in the book to do it. Buffett saw this as a perversion. He knew that the reported net income figure was often a work of fiction, heavily influenced by non-cash charges and accounting assumptions. In his letter, he decided to teach his shareholders, whom he viewed as partners, a better way. He wrote, "If we think through the characteristics of a business, it becomes obvious that reported earnings are not a sensible measure of long-term economic performance." He then laid out his alternative, owner earnings. He defined it as the cash that is generated by the business's operations that can, over time, be distributed to the owners. He used powerful examples to illustrate the flaws in GAAP. Consider a media property, like a newspaper or a television station, that Berkshire owned. Under GAAP rules, they had to depreciate the value of this asset on their income statement every year, which reduced their reported profits. But in economic reality, the value of a dominant media franchise was actually increasing, not decreasing. The depreciation charge was an accounting fiction that understated the true earning power of the business. Conversely, he pointed to capital-intensive businesses, like manufacturing plants, where the GAAP depreciation charge might be far less than the actual amount of money the company needed to spend each year on capital expenditures just to keep its machinery up to date and maintain its competitive position. In this case, GAAP earnings would overstate the true profitability. Buffett's message was clear. Don't let accountants, with their arbitrary rules, tell you how much a business is earning. Think like an owner. The only thing that matters is how much cash you can take out of the business at the end of the year, while ensuring its long-term competitive position remains intact. This was a revolutionary CEO mindset in an era obsessed with the bottom line of the income statement. It was a call to prioritize economic reality over accounting fiction. The psychological principle that Buffett is masterfully overriding here is a combination of the anchoring bias and the framing effect. The anchoring bias is our tendency to rely too heavily on the first piece of information offered when making decisions. In finance, the first and most prominent piece of information in any earnings report is the GAAP net income, or earnings per share, EPS. The entire financial news media machine is built around this number. XYZ Corp reports record earnings of $2.50 per share, beating estimates of $2.48. This single number becomes the anchor for almost all subsequent discussion and analysis. Once that anchor is set, it's very difficult for most people to adjust their thinking away from it. Then comes the framing effect. This is our tendency to be influenced by the way information is presented. A CEO can frame the company's performance by making accounting choices that boost the GAAP EPS number. They might change their assumption about how long a machine will last to reduce annual depreciation charges, or they might capitalize expenses that should be expensed. These are frames that make the picture look prettier than it is. Buffett systematically dismantles this psychological trap. He consciously refuses to anchor on the reported GAAP earnings. He sees that number and immediately treats it with suspicion. His creation of the owner earnings concept is a deliberate act of reframing. He is building a new frame, one based on cash and economic reality, and forcing himself to analyze the company through that lens instead. He is telling his brain, ignore the number they are giving you, that is their frame. We will build our own. This is an act of profound intellectual discipline. It requires swimming against the powerful current of Wall Street consensus and media chatter. While everyone else is anchored to a potentially misleading number, Buffett is often a quiet corner with the cash flow statement, doing the hard work of calculating the truth. This protects him from being swayed by short-term accounting gimmicks and allows him to focus on the long-term cash-generating power that ultimately drives a company's value. This brings us to the applied mental model, the blueprint you can use to emulate this aspect of Buffett's due diligence, the owner earnings calculation. This isn't just a theoretical concept. It's a practical formula that you can apply using a company's financial statements. Step 1. Start with the company's reported net income. You'll find this at the bottom of the income statement. This is our flawed starting point, the GAAP anchor we are seeking to correct. Step 2. Add back all non-cash charges. The most common and significant of these are depreciation and amortization. You can find these figures on the cash flow statement, usually in the cash flow from operations section. These are expenses that the company recorded on its income statement, but they didn't actually involve any cash leaving the bank. We add them back to get closer to a true cash profit figure. Step 3. This is the most important and most difficult step. You must now subtract the average annual amount of capital expenditures, or CapEx, that are required to maintain the company's long-term competitive position and unit volume. Buffett calls this maintenance CapEx. This is the money the company has to spend on new machinery, technology upgrades, and facility maintenance just to stay in the same place, to tread water. You can find the total CapEx figure on the cash flow statement, usually in the cash flow from investing section. The tricky part is that companies don't split out maintenance CapEx from growth CapEx, money spent to expand the business. So you have to be a detective. A good rule of thumb is to look at the CapEx figures for the last 5 to 7 years. In years where the company wasn't growing much, the CapEx figure is a decent proxy for maintenance levels. For a simple approximation, you can often equate maintenance CapEx with the annual depreciation charge, but be careful with this, as inflation can make the true replacement cost much higher. The formula is owner earnings equals net income plus depreciation/amortization maintenance CapEx. The number you are left with is a much more honest assessment of the company's profitability. It is the cash the business is truly generating for its owners. A CEO who discusses the business in these terms in their shareholder letter is signaling that they share this owner-centric mindset. They are a manager you can trust with your capital allocation. Now let's contrast this disciplined approach with the path of the 99%, which can be described as chasing the EPS beat. The vast majority of market participants, from retail investors to highly paid Wall Street analysts, are locked in a quarterly game. Their entire focus is on whether a company's reported GAAP earnings per share for the quarter will beat or miss the consensus analyst estimate. A company that beats the estimate by a single penny will see its stock soar, while one that misses by a penny will see it plummet. This creates a perverse incentive for management. Instead of focusing on long-term value creation, they become obsessed with managing the short-term accounting numbers to produce a smooth, predictable stream of beats. How do they do this? They might slash the research and development budget for a quarter to make the numbers look better, even if it mortgages the company's future. They might offer deep discounts to customers to pull sales forward from the next quarter into the current one, damaging long-term pricing power. Or, most relevant to our discussion, they will cut back on essential maintenance CapEx. A factory manager might know that a critical piece of machinery needs a major overhaul, but the CEO, focused on the quarterly EPS number, will tell him to postpone it. This reduces the CapEx for the quarter, which doesn't directly impact GAAP earnings, but it improves various cash flow metrics that analysts watch, and it signals a disciplined approach to spending. The 99% of investors see this and cheer. They celebrate the EPS beat and the apparent cost control, completely oblivious to the fact that the company's physical plant is slowly decaying. They are rewarding the CEO for actively destroying long-term value in the pursuit of short-term accounting aesthetics. This is the ultimate folly of ignoring owner earnings. It leads investors to celebrate actions that are fundamentally detrimental to their interests as long-term owners. The direct financial connection here is profound and impacts everything from valuation to corporate strategy. When you value a company based on its GAAP earnings, you are playing with fire. If those earnings are being artificially inflated by management through aggressive accounting assumptions or by underspending on maintenance CapEx, you will inevitably overstate the company's intrinsic value. You will pay too much for the stock, eliminating your margin of safety and setting yourself up for poor returns. When you value a company based on a conservative estimate of its owner earnings, you are building your financial house on a foundation of stone. You are analyzing the business based on the cash it actually produces, which is much harder to manipulate than accounting profits. This leads to more realistic valuations and better stock picking. Furthermore, a CEO who focuses on maximizing owner earnings will make far superior capital allocation decisions. When they have $1 of profit, they won't ask, "How can this make next quarter's EPS look good?" They will ask, "What is the highest return use for this dollar of real cash?" The answer might be reinvesting it in high-return growth projects, buying back the company's undervalued stock, acquiring a competitor at a sensible price, or returning the cash to shareholders as a dividend. These are the decisions that create true, lasting wealth. A focus on owner earnings aligns the mindset of the CEO with the mindset of the long-term owner. It transforms the executive from a manager of quarterly perceptions into a steward of long-term capital, and that is a difference that, compounded over years, results in massively superior portfolio growth. We have established the importance of clarity and the superiority of economic reality over accounting fiction. Now we must venture into the fine print, the territory most investors fear and ignore. This brings us to our third pillar, the confession booth, or the idea that a company's footnotes to its financial statements are the ultimate truth serum. Buffett and Munger are famous for their almost obsessive reading of footnotes. They know that while the main financial statements can be dressed up to look pretty, the footnotes are where a company is legally obligated to disclose the assumptions, risks, and obligations that underpin the numbers. An honest management team uses the footnotes to provide further clarity and help the owner understand the business better. A dishonest or promotional management team uses the footnotes to obscure, confuse, and bury critical information in dense legalese. A powerful anecdote that illustrates this principle comes from Berkshire Hathaway's acquisition of General Re, a major reinsurance company, in 1998. On the surface, Gen Re was a prestigious blue-chip firm, but before committing to the multi-billion-dollar deal, Buffett and his team went to work, not on the glossy presentations from investment bankers, but on the dry, tedious pages of General Re's 10K filings. They focused intensely on the footnotes related to their insurance reserves. In the insurance business, reserving is everything. A company collects premiums today and must set aside a reserve of money to pay future claims. Estimating the size of those future claims is an art, not a science, and it's an area ripe for manipulation. A company that wants to boost its current profits can simply assume that future claims will be lower, thus setting aside a smaller, inadequate reserve. In the footnotes of General Re's statements, Buffett and his team found troubling signs. The language was complex, the assumptions were not clearly laid out, and there were indications that the company had been consistently under-reserving for years, particularly on long-tail asbestos and environmental claims. They were, in effect, booking today's profits by pushing massive problems into the future. The footnotes were the confession. They were a roadmap to the rot within the organization. Did this scare Buffett away? No, because by understanding the problem, he could quantify it. He knew General Re was a troubled business, but the footnotes allowed him to estimate the size of the hole. This knowledge allowed Berkshire to structure the acquisition in a way that protected them and gave them the ability to come in, clean house, and fix the reserving problem, which they did over the subsequent years. Contrast this with a company like AIG in the years leading up to the 2008 crisis. Their footnotes related to their massive portfolio of credit default swaps were notoriously opaque and indecipherable. They didn't provide a roadmap to the problem. They were a brick wall. An investor reading those footnotes had no way of knowing that the company was sitting on a mountain of risk that would eventually bring it, and the global financial system, to its knees. The Gen Re story teaches us a vital lesson. Footnotes don't just reveal problems, they reveal the character of the management. Honest managers confess their sins and explain their assumptions. Dishonest ones hide them behind a wall of text. The psychological bias at play here is known as inattentional blindness. This is a phenomenon where we fail to perceive something that is in plain sight because our attention is focused on something else. The most famous experiment involves showing people a video of a group passing a basketball and asking them to count the passes. During the video, a person in a gorilla suit walks through the middle of the scene, but a significant percentage of viewers never see the gorilla at all. Their attention is so narrowly focused on counting the passes that they are blind to the obvious but unexpected event. In finance, the basketballs are the big, bold numbers on the income statement and balance sheet: revenue, net income, total assets. The entire financial media directs our attention to these numbers. The gorilla is the critical information buried on page 73 of the annual report in footnote 11.b. Most investors suffer from profound inattentional blindness. They focus all their energy on the headline numbers, the passes, and they are completely blind to the gorilla of a massive underfunded pension liability or a potentially ruinous lawsuit disclosed in the footnotes. Buffett's method is a conscious strategy to overcome this bias. He knows the gorilla is often the most important part of the story, so he inverts the typical process. Instead of starting with the income statement and maybe, if he has time, glancing at the footnotes, he often starts with the footnotes. He deliberately directs his attention to where he knows the secrets are hidden. He is actively looking for the gorilla. This counterintuitive approach is a key part of his risk management process. He assumes there is always a hidden risk, a hidden assumption, a hidden obligation, and he knows that management's legal confession booth is the most likely place to find it. So how can you apply this detective's mindset? You can use a mental model I call the footnote treasure hunt. This provides a targeted guide for navigating the dense forest of the footnotes to find the most valuable information. The next time you analyze a 10K, don't just read it from front to back. Go on a specific hunt for these 4 critical footnotes. First, hunt for the footnote on revenue recognition. This is usually one of the first footnotes, and it is critically important. It explains how, and times when, the company books a sale. Look for signs of aggressive accounting. Are they booking revenue for long-term contracts before the cash is received, or the service is fully delivered? Is the policy complex and hard to understand? Simple, conservative revenue recognition policies are a hallmark of trustworthy management. Second, go on a hunt for footnotes related to pension and post-retirement obligations. For many older industrial companies, this can be a hidden time bomb. A company might have a massive, underfunded pension plan that is a much larger liability than all the debt on its balance sheet. This information will only be found in the footnotes. Look for the assumptions they use for the discount rate and the expected return on plan assets. Aggressive, overly optimistic assumptions can make a big liability look small. Third, hunt for the footnote on off-balance sheet arrangements and special-purpose entities. This is the big Enron red flag. This is where a company must disclose obligations or structures that are not included on its main balance sheet. If this footnote is long, complex, and confusing, it is a sign of extreme danger. Honest companies have very little to say here. Fourth, hunt for the footnote on commitments and contingencies, specifically the section on litigation. This is where the company discloses any major pending lawsuits. Don't just see if there are lawsuits. Read the company's own description of the situation. Are they dismissive and arrogant? Or do they seem to be taking it seriously, and have they set aside a reasonable reserve for a potential loss? By turning the process into a targeted treasure hunt, you can cut through the noise and focus on the areas where management's choices and character are most clearly revealed. Simple, clear explanations in these areas signal integrity. Legalese, complexity, and aggressive assumptions are signals of risk. The antithesis of this approach is the path of the 99%, the path of the headline reader. The average investor's due diligence process, if it can be called that, begins and ends with the press release. They see a headline from the company. XYZ Corp achieves record profits and raises dividend. They might open the press release and see the big friendly numbers in the summary income statement. They feel a sense of confidence and reassurance. The narrative is positive, the tone is optimistic. They then go and buy the stock, feeling like they've done their homework. They never open the 10K. They have certainly never read a single footnote in their lives. They are making a significant capital allocation decision based on a pre-packaged marketing message crafted by the company's investor relations department. This is the equivalent of a detective deciding to solve a case by only reading the suspect's self-written, glowing character reference. It is an act of willful ignorance. The headline reader is completely vulnerable to any and all accounting shenanigans that are happening beneath the surface. They are the perfect victim for a promotional CEO because they have voluntarily chosen to remain blind to the evidence. The direct financial connection between footnote analysis and wealth preservation is perhaps the most dramatic of all the pillars. It is the ultimate tool for portfolio protection. The footnotes are where you identify and quantify the off-balance sheet risks that can lead to permanent capital loss. An undiscovered multi-billion-dollar pension liability can wipe out a company's entire equity value when interest rates change. A single catastrophic lawsuit, which was dutifully disclosed in the footnotes for years, can lead to bankruptcy. An aggressive revenue recognition policy can create the illusion of growth for years, but when the scheme unravels, the stock can fall 90% in a single day. By reading the footnotes, you are not just analyzing the company, you are stress testing it. You are identifying the hidden icebergs that don't appear on the beautifully rendered map of the main financial statements. This rigorous risk management is what separates the professional value investor from the amateur speculator. It is a discipline that allows you to avoid the blow-ups, sidestep the corporate disasters, and ensure that the companies you partner with are as solid and honest as they appear on the surface. It is the hard work that leads to a safe and prosperous financial journey. Having learned to value clarity, reality, and the confessions in the fine print, we now turn to the fourth pillar of Buffett's management assessment, the balance sheet as a fortress. This principle is about financial conservatism. Buffett has an intense preference for companies with strong balance sheets, characterized by minimal debt and abundant cash. He sees this not as a boring or timid strategy, but as a direct reflection of a management team that prioritizes survival, resilience, and long-term optionality over short-term, debt-fueled growth. A CEO who treats the company's balance sheet like a fortress is a CEO who is building a business to last for 100 years, not just to look good for the next quarter. The ultimate demonstration of this philosophy in action was the 2008 global financial crisis. In the years leading up to 2008, the prevailing wisdom on Wall Street was that corporations should have efficient balance sheets. This was a euphemism for taking on large amounts of debt. Cash sitting on the balance sheet was seen as lazy and unproductive. Investment banks like Lehman Brothers and Bear Stearns, and even industrial giants, were leveraged to the hilt. They used debt to buy back stock, make acquisitions, and pay dividends, all of which juiced their short-term returns and made their executives look like geniuses. During this time, Warren Buffett and Berkshire Hathaway were widely criticized for being too conservative. Berkshire's balance sheet was the opposite of efficient. It was a fortress, piled high with tens of billions of dollars in cash and U.S. Treasury bonds, and with very little debt at the parent company level. Critics called him an old man who had lost his touch, who didn't understand the new paradigm of modern finance. Then, the storm hit. The credit markets froze, and the highly leveraged firms that had been celebrated as brilliant found themselves unable to roll over their short-term debt. Their survival was measured in days, sometimes hours. Lehman Brothers, with its efficient balance sheet, went bankrupt. Bear Stearns was forced into a desperate fire sale. The entire financial system teetered on the brink of collapse. And where was Warren Buffett? He was sitting calmly in Omaha, in the middle of his financial fortress, with a mountain of cash. His prudence was no longer seen as timid. It was seen as prophetic. His fortress-like balance sheet allowed him to do something no one else could: play offense when everyone else was fighting for survival. He became the lender of last resort to the American financial system. He made multi-billion-dollar investments in iconic companies like Goldman Sachs and Bank of America, not on the desperate terms of a seller, but on his own extraordinary terms, receiving high-yielding preferred stock and valuable warrants. This was not an accident. It was the direct result of a decades-long policy of financial conservatism. He knew that crises were inevitable, even if their timing was unpredictable. His CEO mindset was to always be prepared. The balance sheet was his ark, built to withstand the inevitable flood and to be ready to pick up the spoils when the waters receded. The psychological forces that lead most CEOs and investors astray in this regard are the availability heuristic and recency bias. The availability heuristic is our mental shortcut of judging the likelihood of an event by how easily examples come to mind. In a long, raging bull market, credit is cheap and easily available. The most easily available examples are companies that are using leverage to grow quickly and whose stocks are soaring. Bankruptcies and financial crises feel like distant, abstract concepts. Because examples of success via leverage are readily available and examples of failure are not, managers and investors come to believe that high debt levels are safe and prudent. This is compounded by recency bias, our tendency to give greater importance to more recent events. If there hasn't been a severe recession or credit crisis for 5 or 10 years, people's sense of risk atrophies. They forget the lessons of the past. They start to believe that this time is different. Buffett's entire philosophy of maintaining a fortress balance sheet is a structural defense against these two powerful biases. He operates with the permanent, deeply ingrained belief that a crisis is always just around the corner. He doesn't need a recent example of a panic to remember how terrifying one can be. His memory stretches back through the panics of the 70s, the crash of '87, and even the stories he read about the Great Depression. He actively fights recency bias by studying financial history. He counteracts the availability heuristic by deliberately focusing on the risks of leverage, not just its rewards. His insistence on a cash-rich, low-debt balance sheet is a form of corporate pre-commitment. It is a policy that prevents him or any of his managers from being seduced by the siren song of cheap debt during the giddy highs of a bull market. It is a permanent expression of a CEO mindset that prioritizes long-term resilience over short-term performance. To apply this principle to your own stock analysis, you can use a mental model I call the Financial Fortress Test. This is a simple checklist for analyzing a company's balance sheet to gauge the conservatism and prudence of its management. Step 1. Check the debt-to-equity ratio. You can calculate this by taking the company's total debt and dividing it by its total shareholders' equity. While the ideal ratio varies by industry, you are looking for a number that is low relative to its direct competitors. A company with significantly less debt than its peers is often managed by a more conservative and risk-averse team. Step 2. Look at the current ratio. This is calculated by dividing current assets by current liabilities. This is a measure of a company's ability to pay its short-term bills. A ratio comfortably above 1.5, and ideally above 2, indicates a strong liquidity position. It means the company has more than enough cash and other short-term assets to cover its obligations for the coming year. A ratio below 1 is a major red flag. Step 3. Examine the cash and equivalents line item on the balance sheet. Is it a substantial number relative to the company's annual revenues or expenses? Does the company have enough cash to operate for 6 months or a year without any incoming revenue? A large cash pile is a sign of a management team that values flexibility and is preparing for unforeseen troubles or opportunities. Step 4. Don't just look at the amount of debt, read the debt footnotes. The treasure hunt continues. Find out what the interest rates are. Is the debt mostly fixed rate, which is predictable, or variable rate, which could become very expensive if interest rates rise? What are the maturity dates? Is a huge amount of debt coming due in the next year, which could pose a refinancing risk? A management team that has prudently termed out its debt at low, fixed interest rates is demonstrating a superior level of financial stewardship. A company that passes the financial fortress test is a company that is built to last. The antithesis of this prudent approach is the path of the 99%, which has fallen for what can be called the cult of leverage. In modern finance, particularly with the rise of private equity and activist investors, leverage is often worshipped as the key to unlocking shareholder value. CEOs are frequently criticized and targeted if they maintain a lazy balance sheet with too much cash and not enough debt. They are pressured to borrow heavily to finance massive acquisitions or to buy back huge amounts of stock. These actions have an immediate and powerful effect. They reduce the number of shares outstanding, which automatically increases the earnings per share figure. This often leads to a higher stock price in the short term and triggers massive bonuses for the executives. The 99% of investors cheer this on. They see it as bold, aggressive, and shareholder-friendly management. They read headlines about a strategic levering up and believe they are witnessing financial genius. They completely ignore the fact that leverage is a double-edged sword. It amplifies returns on the way up, but it also amplifies losses on the way down and dramatically increases the risk of bankruptcy. The cult of leverage encourages CEOs to take on enormous risks with the company's long-term survival in order to generate short-term stock price gains. Investors who celebrate this behavior are like passengers on a ship cheering the captain for throwing all the lifeboats overboard to make the ship lighter and faster. It seems like a great idea until a storm appears on the horizon. The 99% focuses on the return of their investment through buybacks, while Buffett focuses on the return his investment and, most importantly, the survival of his investment. The direct financial connection between a fortress balance sheet and long-term wealth creation can be summarized in one word: optionality. A cash-rich, low-debt balance sheet is the ultimate source of corporate flexibility and strategic advantage. It gives a management team a set of valuable options that its leveraged competitors simply do not have. First, it provides the option to survive. A company with a fortress balance sheet can weather any recession or industry downturn without having to panic. They won't be forced to sell off their best assets at fire sale prices or dilute their existing shareholders by issuing new stock at depressed levels just to stay afloat. This prevention of permanent capital impairment is the first and most critical step in long-term compounding. Second, it provides the option to play offense. As we saw in the 2008 crisis, a fortress balance sheet allows a company to acquire distressed competitors, technologies, or assets at bargain basement prices when capital is scarce and fear is rampant. These are the kinds of acquisitions that can generate spectacular returns for decades. Third, it provides the option to invest for the long term. When a downturn hits, leveraged companies are forced to slash their budgets for research and development, marketing, and expansion. The company with the fortress balance sheet can double down on these investments, gaining market share and widening its competitive moat while its rivals are in retreat. This optionality, born from financial conservatism, is a massive tangible asset. It may not show up as a line item on the balance sheet, but its value is immense. It directly translates into a higher probability of long-term survival and prosperity, and a dramatically lower risk of catastrophic loss, which is the true secret to superior portfolio growth over time. We have now arrived at the fifth and final pillar, the one that ties all the others together. It moves beyond the numbers and into the realm of pure communication and character. This is the Candor Covenant, the principle that the CEO's annual letter to shareholders is a personal promise, a sacred contract. For Buffett, this letter is the ultimate qualitative signal. He believes a CEO should not write like a public relations professional, but like a senior partner in a business writing to his other partners. The letter should be a transparent, honest, and educational account of the year's events, openly discussing mistakes and challenges with the same prominence as successes. The tone and content of this letter are, for Buffett, the final and most telling piece of evidence in his assessment of a CEO's trustworthiness. The greatest source of anecdotes for this pillar is, of course, Warren Buffett himself. His annual letters to the shareholders of Berkshire Hathaway, are the gold standard of corporate communication. They are legendary for their clarity, wit, and, most importantly, their unflinching honesty about mistakes. A prime example is his discussion of the 1993 acquisition of Dexter Shoe Company. Berkshire paid for Dexter with 25,203 shares of Berkshire A stock, which at the time were worth about $433 million. A few years later, Dexter's competitive advantage, which Buffett had believed to be durable, evaporated due to foreign competition. The business became worthless. In a typical CEO letter, this failure would be ignored, glossed over, or blamed on unforeseeable external factors. But in his 2007 letter, Buffett laid the mistake bare for all to see. He wrote, "I made a terrible mistake in buying Dexter Shoe. What I had assessed as a durable competitive advantage vanished within a few years." But he didn't stop there. He went on to explain the true, catastrophic cost of his error. Because he had paid with Berkshire stock instead of cash, the real cost was not the $433 million. It was what those Berkshire shares would be worth in the future. He calculated that by 2007, those shares were worth $3.5 billion. He wrote, "As a financial disaster, this one deserves a spot in the Guinness Book of World Records." He didn't hide it, he didn't spin it. He took personal responsibility, quantified the failure in the most painful terms imaginable, and used it as a teaching moment for his shareholders. This act of radical candor did not diminish his stature, it enhanced it immensely. It built a bond of trust with his shareholders that is unparalleled in modern corporate history. They knew, without a doubt, that he would always tell them the truth, good or bad. The psychological principle that makes this strategy so effective is known as the pratfall effect. Research has shown that a person's attractiveness and likability can actually increase after they make a mistake or show a moment of vulnerability, but with one crucial condition: they must first be perceived as highly competent. When an average person makes a mistake, it just confirms their mediocrity. But when a person of high status or proven competence, a Nobel laureate, a star athlete, or a world-renowned CEO, makes a mistake and openly admits it, it has a surprising effect. It makes them seem less arrogant, more human, more approachable, and, paradoxically, more trustworthy. It shatters the artificial barrier of perfection that so many leaders try to construct around themselves. The pratfall short-circuits our natural skepticism. We are hardwired to be suspicious of people who claim to be perfect. When a leader like Buffett openly discusses a multi-billion-dollar blunder, he is performing a pratfall. He is signaling to his partners, "I am competent, but I am not infallible. I will not hide my errors from you." This act of vulnerability is a powerful display of confidence and integrity. It demonstrates that he is secure enough in his overall record and his relationship with his shareholders that he doesn't need to pretend to be perfect. To systematize the analysis of this crucial qualitative signal, we can use a mental model called the Candor Scorecard. When you read a CEO's annual letter to shareholders, don't just passively absorb the words, actively score it based on these 5 factors. 1. Mistake admission. Score it from 1, no mention of anything negative, to 5. Openly discusses a specific major mistake and takes personal responsibility. Does the CEO talk about what went wrong during the year, or only what went right? 2. Plain language. Score it from 1, filled with impenetrable corporate jargon and buzzwords, to 5. Written in clear, simple, conversational English. Does it feel like a human being wrote it? 3. Long-term focus. Score it from 1. Obsessed with the last quarter's results and the stock price, to 5. Focused on the business strategy and competitive landscape for the next 5 to 10 years. Is the CEO a steward for the long haul or a manager of short-term expectations? 4. Specific metrics. Score it from 1. Uses vague platitudes like creating shareholder value, to 5. Uses specific relevant business metrics like owner earnings or return on invested capital, and explains why they are important. Do they measure what counts or just what sounds good? 5. Partner tone. Score it from 1, reads like a glossy, self-congratulatory marketing brochure, to 5, reads like a candid, personal letter to a trusted business partner. Is the CEO trying to sell you something, or are they trying to inform you? After reading the letter, add up your scores. A letter that scores 20 or higher is a strong indicator of a CEO with a Buffett-like mindset, a leader you can likely trust. A letter that scores 10 or lower is a major red flag, suggesting a promotional and untrustworthy management culture. The antithesis of the candor covenant is what 99% of companies produce, the promotional pamphlet. Most CEO letters are not genuine communications. They are marketing documents, carefully crafted by teams of lawyers, investor relations professionals, and public relations experts. They are exercises in corporate spin. They are invariably filled with smiling pictures of happy employees, sweeping and vague mission statements, and a thicket of the latest corporate buzzwords: synergy, digital transformation, leveraging our platform, disruptive innovation. They are designed to project an image of flawless execution and boundless optimism. Every minor success is magnified and celebrated, while failures, challenges, and risks are completely ignored, glossed over, or buried in boilerplate legal disclaimers. The average investor reads this promotional pamphlet, feels reassured by the relentlessly positive tone, and mistakes professional marketing for genuine management integrity. They are being lulled into a false sense of security. They are reading a document designed to manage their perceptions, not one designed to inform their judgment. This is the path to ruin, because the CEO who will not be honest with you about small problems is a CEO who will almost certainly hide the big ones until it is far too late. The direct financial connection between candor and long-term returns is real, even if it is not immediately obvious on a spreadsheet. A CEO who is candid and transparent in their annual letter is highly likely to foster a culture of honesty and accountability throughout the entire organization. This is the ultimate form of sound corporate governance. In a culture of candor, bad news travels up the chain of command quickly. An engineer on the factory floor feels safe telling their manager about a critical quality control issue. A salesperson feels comfortable telling their boss that a new competitor is taking market share. Problems are identified and addressed when they are small and manageable, not hidden and allowed to fester until they become company-threatening catastrophes. This culture of intellectual honesty is a powerful, though unquantifiable, asset. It leads to better risk management, more efficient operations, and, most importantly, more intelligent capital allocation. A management team that is honest with itself and its shareholders is a management team that is more likely to make rational, value-creating decisions over the long run. The candor in the CEO's letter is not just about words. It is a window into the operating system of the entire company. It is the ultimate signal that you are partnering with people who are not only competent, but who are worthy of your trust. You have just spent this time acquiring a powerful and rare mental tool. You have moved beyond the superficial analysis of stock charts and media headlines. You now possess a framework for using a company's financial statements not merely as a record of its past, but as a deep, penetrating window into the character, integrity, and mindset of its management. You have learned how to read between the lines, to distinguish the honest partner from the slick promoter, the steward of capital from the manager of perceptions. This is a skill that will serve as a permanent shield, a tool for risk management that will protect your wealth from the hidden dangers of deceptive accounting and untrustworthy leadership. But understanding the character of the pilot is only the first half of the equation. A great pilot in a faulty aircraft is still a perilous investment. This framework you have just mastered is one crucial piece of a much larger, interconnected system of thought that Buffett employs. You have learned how to answer the question, "Who am I getting into business with?" The next, equally critical question is, what is the fundamental quality of the business they are managing? How do you identify a company with a truly durable competitive advantage, an economic moat that can protect its profits from the relentless onslaught of competition for decades to come? The principles for identifying an honest CEO and the principles for identifying a great business are not separate. They are two sides of the same coin of value investing. One without the other is a trap. An honest CEO running a terrible commodity-like business will likely produce poor returns. A brilliant business run by a dishonest or incompetent CEO can be driven into the ground. The ultimate goal is to find the rare combination of both. The video that is now appearing on your screen is the missing link. It is the next piece of the map. It is the bridge that connects the who with the what. It will show you how to take your newfound ability to judge management and combine it with the timeless principles for identifying a business with an unconquerable economic fortress. You have just sharpened one of the most critical tools in your financial arsenal. But the journey to becoming a truly sophisticated investor, the kind of person who builds lasting generational wealth, is not about collecting single tricks. It is about building a complete, interlocking mental framework, a latticework of models that allow you to see the world as it truly is. You have laid a crucial part of that foundation today. Do not stop now. The momentum is with you. Complete the framework. Continue your ascent from amateur to professional. The next piece of your mental arsenal is waiting. Click on the video and take the next step.